They did it on a Sunday. While you were sleeping, while the markets were closed, while America was watching football and scrolling through memes, Beijing gave the order. Sell. Not a press release, not a policy paper, a verbal command, delivered behind closed doors, with no paper trail, no official memo, and no fingerprints. Chinese regulators walked into meetings with the country's largest commercial banks and told them to reduce their holdings of United States government debt. Limit new purchases. If your exposure is too high, start offloading. Now. Bloomberg broke the story on February 9, 2026. Almost nobody covered it. The financial media buried it under earnings reports and tech stock gossip. But this single directive is the most dangerous financial event of the year. Because it does not just mean China is selling bonds, it means Beijing has officially weaponized its entire banking system against the American dollar. And if you have a mortgage, a savings account, a retirement fund, or a credit card, you just became collateral damage in a war you did not sign up for. Let me show you exactly how this kills your purchasing power, why the real numbers are 3 times worse than what the headlines say, and the specific date in 2026 when we will know if the damage is containable or if the floor falls out entirely. I track these shifts so you see the signal before it becomes a headline. Hit that subscribe button right now. I read every single comment to see how real people are feeling about this economy. Let me know below. Has your bank said a single word about this? Also, a quick shout out to my partner channel Finance Unfold. Go follow them as we build an army of informed investors who refuse to be the last ones standing when the music stops. Now here is why this Bloomberg report is fundamentally different from every other China sells treasuries headline you have ever seen. And trust me, this distinction will change how you see the entire global financial system. For the past decade, the selling has come from one place, the People's Bank of China, the central bank. They have been trimming their treasury holdings gradually from a peak of $1.32 trillion in 2013 down to about $683 billion by the end of 2025. That is the number you see on every chart. That is the number analysts talk about on television. And that number by itself is manageable. It is a slow drip. The bond market can absorb a slow drip. But this directive is not about the central bank. This is about commercial banks. Think of it like the difference between the Pentagon and every military base in the country. The Pentagon might quietly adjust strategy, but when every base gets marching orders simultaneously, that is mobilization. That is a different scale entirely. Chinese commercial banks collectively held $298 billion in United States dollar-denominated bonds as of September 2025. That is a separate pool of American debt sitting on a separate set of balance sheets that most analysts completely ignore. When you see Bloomberg flash a headline about Chinese holdings dropping to $683 billion, they are only counting the central bank's reserves. The commercial banks are invisible in that number. Add both channels together, and Beijing controls close to $1 trillion in American debt. And now, for the first time in history, both channels have received the same instruction. Reduce exposure. Get out. This is not a policy adjustment. This is an escalation. The central bank selling was the reconnaissance mission. This directive to commercial banks is the ground invasion, and it was wrapped in the most careful diplomatic language imaginable. The regulators called it diversification. They cited concentration risk and market volatility. They never mentioned geopolitics. They never said they lost confidence in the dollar. But you do not issue a verbal command with no paper trail because you are feeling calm and confident. You do that when you are preparing for a fight, and you do not want the other side to see it coming. Now here is where this story goes from alarming to terrifying. There is a shadow operation happening in Europe that reveals the official numbers are a carefully constructed illusion. And once you see it, you cannot unsee it. Look at Belgium, a country with a smaller economy than the state of Ohio. According to United States Treasury data, Belgium holds $481 billion in American government bonds. Luxembourg, a nation you could drive across during a lunch break, holds $425 billion. Those numbers should make you laugh. These are not global financial superpowers. They are not running massive sovereign wealth funds. They are holding China's money. Euroclear Bank is headquartered in Belgium. Clearstream operates out of Luxembourg. These are the two largest cross-border settlement platforms in the world. When Beijing wants to park treasury bonds outside the reach of American sanctions, outside the jurisdiction where the United States froze $300 billion of Russian reserves overnight in 2022, they route those bonds through custodial accounts in Brussels and Luxembourg. The bonds are still Chinese. The risk is still Chinese. The beneficial owner is still Beijing. But on the official Treasury Department report, they show up as Belgian. The Treasury Department admits this. Their own FAQ states, and I need you to hear this clearly, that if a Treasury security purchased by a foreign resident is held in a custodial account in a third country, the true country of ownership will not be reflected. The government is telling you in plain English that their own data is wrong. They know the numbers are misleading. They publish them anyway. Now do the math. China's official holdings dropped by roughly $600 billion over a decade. Over the same period, Belgium's holdings quadrupled. That is not a coincidence. That is a shell game being run at sovereign scale. Imagine a poker player who keeps moving chips between pockets so the table cannot see how much he is actually holding. That is what Beijing has been doing for 10 years. They did not sell $600 billion in American debt. They relocated a massive portion of it to a jurisdiction where American regulators cannot touch it. They built a firewall between their wealth and American political power. And they did it so quietly that most of Wall Street still has not figured it out. This is why the headline numbers are lying to you. Every analyst who tells you that China's selling is manageable because their official holdings are only $683 billion is looking at one pocket and ignoring the other three. But here is the nightmare scenario. If Beijing's commercial banks start selling their $298 billion and the central bank continues its drawdown, and the custodial accounts in Belgium and Luxembourg begin unwinding, the total wave of selling could approach $1 trillion, spread across 3 channels, happening simultaneously. That is not a slow drip anymore. That is a fire hose pointed at the bond market. If this is clicking for you, if you are starting to see the scale of what is really happening behind the curtain, hit that like button right now. One click changes who the algorithm shows this to. This is information that needs to reach people before the next phase begins. And the timing of this directive could not be worse for you. Weeks after Beijing issued the order, the United States entered a military conflict with Iran. The Strait of Hormuz, the narrow choke point through which 20% of the world's oil flows, is now effectively disrupted. Oil prices have surged to levels not seen since 2022. The 10-year Treasury yield has climbed above 4.25%, and the dollar index is hovering below 95, a level that tells you the currency is sick. Think about what Beijing saw before anyone else did. They issued this directive before the Iran conflict erupted. They read the chessboard better than Wall Street. They understood that tariffs plus military adventurism plus fiscal recklessness was a toxic cocktail for the dollar. The Iran war is not a separate story. It is gasoline poured on a fire that was already burning. Every cruise missile costs money. Every carrier group deployed burns budget. Every week the strait stays disrupted, pushes oil higher, pushes inflation higher, and pushes the Federal Reserve deeper into a corner where cutting rates means igniting a price spiral, and holding rates means strangling the economy. And here is the thread that ties it all together. China is the world's largest oil importer. For the past 2 years, they have been settling a growing share of oil purchases in yuan, not dollars. Every barrel of oil sold outside the dollar is one less reason for the world to hold American debt. The Iran war accelerates this shift because it proves exactly what Beijing has been arguing. Relying on the dollar means relying on American foreign policy decisions you cannot control. And American foreign policy just shut down the most critical oil transit route on the planet. Now look at the math from your kitchen table. The United States government runs a $2 trillion annual deficit. That was before the war. Military operations in the Middle East could add hundreds of billions more. Every dollar of that deficit has to be funded by selling new bonds. But China just told its banks to stop buying. Japan, the largest foreign holder, has been selling for over a year to defend the yen. The United Kingdom is consumed by its own fiscal crisis. India and Brazil are reducing exposure. The BRICS nations are building payment systems that bypass the dollar entirely. So who is left to buy $2 trillion in new bonds every single year? You, the American saver, the American retiree, the person reading this right now. And to convince you to buy a 10-year bond in this environment, the government has to offer a yield so juicy that it crushes the housing market, chokes every small business trying to get a loan, and turns your credit card statement into a horror movie. Meanwhile, the United States is already spending over $1 trillion a year just on interest payments. Not paying down debt, just servicing the interest. That is more than the defense budget. That is more than Medicare. Think about what that means. Every tax dollar you send to Washington, a growing share goes straight to bondholders. It does not build a road. It does not fund a school. It does not protect your border. It pays interest on money that was already spent years ago on programs that have already ended. This is the doom loop. It is a treadmill that keeps getting faster. The government borrows to survive. But to borrow, it pays higher rates. Higher rates slow the economy. A slower economy means less tax revenue. Less revenue means a bigger deficit. A bigger deficit means more borrowing at even higher rates. You cannot slow down because the belt is accelerating. You cannot jump off because there is $36 trillion of existing debt chained to your ankles. And China just cranked up the speed. Now let me make this personal because most people hear the words bond market and their eyes glaze over. But the bond market is not an abstraction. It is the control panel for your entire financial life. The 10-year Treasury yield is the benchmark that sets your mortgage rate. When China's banks sell treasuries, it pushes that yield higher. When the yield goes higher, your mortgage rate follows. The Federal Reserve is powerless to stop this because the Fed only controls the short end of the curve. The bond market controls the long end. And the bond market is now being shaped by the selling decisions of a foreign government that no longer trusts the United States to manage its own finances. Think about what that means if you are trying to buy a home. Mortgage rates are already at levels that would have seemed insane 3 years ago. If Chinese commercial bank selling accelerates through 2026, rates could push higher regardless of what the Fed does with its benchmark rate. You could see a scenario where the Fed cuts short-term rates to zero and your mortgage rate goes up. That is not a contradiction. That is fiscal dominance. It means the debt pile is bigger than the central bank's ability to control the economy. The math has taken over, and you are the variable being squeezed. If you are a small business owner trying to get a loan, the same math applies. Higher treasury yields mean higher borrowing costs across the board. Your credit line gets more expensive. Your expansion plans get shelved. Your competitors who locked in cheap debt 3 years ago have an advantage you will never close. This is not a Wall Street problem. This is a Main Street execution. And if you are sitting in a retirement account loaded with bond funds, you need to understand that every basis point increase in yield is a direct hit to the value of your portfolio. Long-duration bonds lose money when rates rise. The longer the duration, the bigger the loss. If you are 5 years from retirement and your safety allocation is in 20-year treasuries, you are not playing defense. You are standing on a trap door. Here is what most people miss about how Beijing delivered this order. It was verbal. No deadlines. No specific targets. That sounds soft. It sounds like a suggestion. But if you understand how the Chinese system works, a verbal directive from a regulator is a command delivered without fingerprints. There is no document to leak, no memo to subpoena, no headline for diplomats to argue about. Beijing can deny the order ever existed while their banks quietly execute it over the next 18 months. Think of it like a medieval siege. They are not storming the gates, they are poisoning the well. Every month, a few billion leaves the system. Every sale nudges yields a fraction higher. Every tick upward on the yield curve makes it a tiny bit more expensive for America to borrow. Individually, each move is invisible. Cumulatively, over 12 to 18 months, the damage is catastrophic. And the elegance of the strategy is what makes it so dangerous. Beijing is not doing anything technically hostile. They are diversifying. They are managing risk. They are doing what any responsible institution would do when the asset they hold becomes volatile and unpredictable. They have wrapped a weapon in the language of prudence, and every financial regulator on earth is watching them do it and taking notes. This is how contagion works in the bond market. It does not start with a crash. It starts with a quiet exit. One major player slips out the back door, then another notices and follows, then a third. By the time the crowd realizes the room is emptying, the exits are jammed, and the price of getting out has tripled. Meanwhile, follow the money. Where is Beijing redirecting the capital it is pulling out of treasuries? Gold. The People's Bank of China has been buying gold for over 15 consecutive months. Central banks globally purchased over 1,000 tons of gold in each of the last 3 years. Gold is trading above $5,000 an ounce. That is not a speculative frenzy. That is a global vote of no confidence in American fiscal policy. 95% of central banks surveyed by the World Gold Council expect to increase their gold reserves this year. The dollar's share of global foreign exchange reserves has fallen to roughly 40%, the lowest since 1994. Gold's share has climbed to approximately 30%, the highest since 1991. Poland is buying. Brazil is buying, India is buying, Kazakhstan, Uzbekistan, the Czech Republic, all stacking metal into their vaults at a pace that has not been seen in half a century. And they are not buying because they think gold is pretty. They are buying because they are watching Beijing dismantle its exposure to the dollar, and they are asking themselves a very simple question. If the second largest economy on earth does not trust American debt anymore, why should we? These are not abstract numbers. These are the load-bearing walls of the global financial system being rebuilt in real time, with gold at the center instead of the dollar. So what do? How do you protect yourself when the very foundation is shifting? Here is where I need to be different from every other voice telling you to just buy gold and hope for the best. Because the situation is more nuanced than that, and the playbook has to be more specific. First, you need to stress test your fixed income exposure immediately. If you own long-term treasury bonds or bond funds with duration above 7 years, you are sitting on the most dangerous asset in the market right now. You are betting that the United States government can manage $36 trillion in debt while its biggest foreign creditors are heading for the exits, and a new war is draining the budget. Every tick higher in yields means the price of your bonds drops. This is not a conservative position. It is a leveraged bet on political competence. Shorten your duration. Move to treasury bills under 1 year if you want government paper. At least you get your money back fast enough to redeploy before the next shock. Second, you need to understand the difference between paper exposure and physical exposure. Owning a gold ETF is not the same as owning gold. You own a claim. You own a promise from a financial institution. If the system seizes up, that institution can settle your claim in cash at whatever price they choose. China figured this out years ago. They stopped storing gold in London and New York. They are taking physical delivery and shipping it home. If you are going to hold precious metals as insurance, make sure you actually possess the insurance policy. Third, watch the 10-year Treasury yield like your financial life depends on it, because it does. That yield determines your mortgage rate, your car loan rate, your small business borrowing cost, everything. If it breaks above 4.5% and holds there through the second quarter of 2026, that is the signal that the bond market has lost confidence in the government's ability to fund itself without the money printer. That is your red line. That is the specific indicator that tells you the next phase of this crisis has begun. Mark that level. Watch it daily. Because the moment that line breaks, the Federal Reserve will face an impossible choice. Either they restart quantitative easing, which means printing money and destroying the dollar's purchasing power, or they let the bond market crash, which means mortgage rates spike, banks fail, and the economy enters a recession that makes 2008 look like a rehearsal. There is no door number 3. There are only 2 flavors of pain. Fourth, you need income that is not denominated purely in dollars. This does not mean you need to move to another country. It means you need assets that generate returns in currencies or commodities that benefit when the dollar weakens. Energy royalties, international dividend stocks, commodity producers. These are the cash flows that get stronger as the dollar gets weaker. They are your hedge against the very devaluation that Beijing's directive is designed to accelerate. Think of it like an insurance policy that actually pays you while you hold it. You are not just protecting against downside. You are positioned to benefit from the exact trend that is already in motion. Fifth, and this might be the most important shift of all, you need to change how you think about cash. For the last 2 years, people have been parking money in high-yield savings accounts, earning 4 or 5% and feeling smart about it. But if the dollar is losing 6 or 7% in real purchasing power every year, you are paying for the privilege of losing money slowly. Cash is not safety. Cash is a melting ice cube. You need assets that appreciate as the dollar depreciates. Hard assets, productive assets, things the world needs regardless of which currency sits on top. The days of sitting in cash and waiting for clarity are over. There is no clarity coming. There is only the slow grind of a system being restructured while you watch. The dollar is not going to zero tomorrow. It is still the world's dominant reserve currency. It still controls the majority of global trade settlement. But dominance and invincibility are not the same thing. The British pound ruled global finance for over a century before it did not. The transition did not happen overnight. It happened slowly, then all at once. The Bloomberg report from February 9th is another crack in the ice. Small enough to ignore if you are not looking, but it is growing wider every single month. And there is one more dimension to this that nobody is discussing. These commercial banks are not just passive holders of bonds. They use Treasury bonds as collateral to access dollar liquidity in repo markets. They use them to settle international trade. When these banks reduce their Treasury holdings, it does not just remove a buyer. It drains the lubricant from the global dollar system. It tightens liquidity in ways that ripple through every financial market on the planet. This is why the dollar index dropped nearly 1% the day the Bloomberg report hit. It was not just about bond selling. It was the market realizing that the plumbing of the dollar system itself is being quietly dismantled from the inside. Beijing gave the order on a Sunday. No cameras, no press conference, no paper trail, just a whisper that will echo through the bond market for years. The commercial banks received the message. The selling has begun. And the most dangerous part is that it will happen so gradually, so quietly, that most people will not notice until the cumulative damage is already baked into their mortgage rate, their grocery bill, and their retirement balance. The question is not whether you believe it matters. The question is whether you will still be standing when the echo reaches your bank account. Most Americans will not be. They are holding dollars in savings accounts earning 4% while inflation eats 6%. They are sitting in portfolios designed for a world that no longer exists. They are trusting institutions that have already been abandoned by the nations that built them. Do not be most Americans. Be the person who read the report nobody covered. Be the person who understood the Belgium shell game before cable news figured it out. Be the person who checked their bond duration while everyone else was doom scrolling. The wealth transfer is not a theory. It is arithmetic. When a government devalues its currency to service its debt, wealth moves from savers to borrowers. The biggest borrower on earth is the United States government. They are diluting your labor, your time, your life, one printed dollar at a time. China understood this a decade ago. Japan is learning it now. Europe is waking up. The only question left is whether you figure it out before or after the alarm has already gone off. But knowing the trap exists is only the first step. You need to know exactly when the next fracture appears. There is a specific date on the calendar when the Federal Reserve has to make a decision that will either stabilize the bond market or accelerate the collapse. The early signals are already flashing. I broke down the exact timeline, the 3 scenarios that could play out, and the specific assets that benefit from each outcome in this video right here. Click it now. I will show you the chart that the Treasury Department does not want you to see. I will see you there.